All right. Brian Wilson here. Today's date is December 4th. Already moving into December. I hope you had a wonderful Thanksgiving. My wife and I were in San Diego spending some time with our daughter and her husband. We had a wonderful time. It was a little difficult, I'll be honest, to come back on Monday evening, and we were waiting for a shuttle at about 11 o'clock that evening, probably 30 degrees outside, waiting for about 15 minutes. But if that was the worst that happened, we had it pretty easy. But thank you for coming today. Just a couple of rules to discuss. All questions are welcome. You're welcome to put those in the chat room itself as we make our way through here. Today, you're also welcome to stop me and ask those questions, if you want to. Please mute yourself as we're kind of walking through this, just so we don't distract everyone else. Laura, I saw that can everyone hear me right now? I know I was muted earlier. Are we okay? Okay, John Sebastian, thank you. I appreciate that. I thought I was okay now. Boris cannot hear me either. Let me try one other. It looks like it's a mixture. Okay, that's interesting. I'll turn up my volume just a little bit, just in case. Okay, so it looks like about three-quarters can hear me. All right. Well, we'll go ahead and Forrest, you had a question. Go ahead, please.
Right.
All right. Okay, no problem, Forrest. We'll go ahead and get going. As I mentioned, couple rules of engagement. Just mute yourself as we're walking through this, if you don't mind. And in fact, I'm going to mute everybody here real quick. We're getting a little bit of background noise. Okay, I think that should be better. Let me see if there was any questions here. Okay, just some of the audio questions. Okay, we'll go ahead and get started. I have about 6 or 7 topics, and I'll kind of circle back to this main room a couple of times as we make our way through, just to see if any questions have come in. I'll go ahead and get started with what I call market behaviors. I've touched on this topic a couple of times when we've had previous discussions. Let me share my screen. And apologies. One thing I forgot to do before the meeting was to minimize my screens. That's my fault. So we'll get everything figured out here, guys. Thank you very much for being patient with me. So if we look at what we call market behaviors, 4 behaviors in the marketplace, and this is just a good review once in a while, just to see how the world has changed. You hear us talking about these different behaviors, and really it is an upside down world. It's like waking up on a different planet. This was the world that I was familiar with when I was a buy-side trader. So active investors were about 80% of daily trading. And what we mean by these levels, let's say that you had 100,000 shares that is trading. Back in the day, that meant that about 80,000 was coming from active investors. You had some speculative trading, you had some other activity. Look at how the world has changed now. So we have 10% of the money that is a reflection of fundamentals or stock story. Fast trading, 46, 47%. This is high frequency trading strategies. Sometimes you can call it market making. They are making markets, but they're also pursuing daily trends as well. Passive investment activity. Think about index funds, ETFs, quant fund trading, about 25% of daily trading. And then lastly, risk management trading. What are we doing with derivatives, whether to leverage or protect positions? About 19% of trading. Now, when we think about these different behaviors, let's take it one step further and think about what they actually do in the marketplace. So active investors, when we think about them, it's institutional investors. They care about the stock story. They care about investments because of their unique characteristics. Think about what's on CNBC all day. That's tuning into the stock story. But once again, think about the fact that that's only about 10% of daily trading. It's not, as a general rule, that's not going to be the behavior that's moving shares. Passive money continues to grow at the expense of active investors. What do passive investors care about? Well, they care about characteristics. They are buying things because shares possess similar characteristics to other shares. So, what are some of those characteristics? Well, you have size. That's really the number one. And think about market cap. You have value versus growth characteristics. You have sector, you have volatility, and then you have factor-based investment. And just for a second, what do I mean by factors? This is what I mean by factors. I thought this was a good way to just briefly talk about that one element. So you can have value factors, momentum factors, size, we've already talked about that a little bit, quality or low volatility. So that's some of the factor ETFs that are out there. But once again, that's probably number 5 on the list when we think about those passive characteristics. Let's circle back then to that. This is where we were looking at passive money. They care about characteristics. Fast trading, what do the machines care about? They're just trying to profit from the trading process itself. They're the closest ones to the order routers. They're divvying up their orders in very small increments, so they don't have a lot of capital at risk. And they're the ones that are out there on the bid and on the offer, and then trying to figure out which way a stock is going at a particular time and trying to profit by doing that. And then lastly, that risk management element, trying to manage risk, looking at options, forwards, and futures, huge part of the market, roughly double to what active investors are doing in the market. So I just wanted to briefly, review what was going on there. Let me for a moment show you what's been going on from an underlying stock and from an SPY perspective. So this is a report. It's a modern IR report that we run the other side of our business. Wanted to show you what was happening as the market went into rally mode. What you're looking at here is what we call the patterns look. If you're above the 0 axis, that reflects greater influence from a given behavior. So what behaviors are really moving the market? This was the end of expirations on the 21st, and the market ripped higher after that. Who were the buyers? Active and passive investors. And then it's turned into a little bit of a fast trading market here over the course of the last few days. Look at the SPY. It's exactly the same. So this is our SPY report. And when we look at those behaviors, you can see the corresponding price chart on this one. That's a big, big pattern. So we had weakness into expirations. You can see that there was very limited activity going on in the market. It was basically a fast trading market. Investors came back with a charge coming out of expirations. The whole market ripped higher, and we're in a little bit of a pause right now. And who's behind the pause right now? That's fast traders. So I wanted to show you what's going on there with the SPY and S&P 500. Let me pause for just a moment and see if any questions have come in, and I'll stop sharing. Doesn't look like we have any questions right now. Once again, if you do have anything come in, one from Candace. Who's responsible for the majority of fast trading? Candace, that's the I call them the fast trading firms. It's the Citadels of the world. It's those types of firms that are out there. In some cases, they're referred to as market makers. I don't necessarily like that firm, but it's those firms. It's the Citadels of the firm. Which category does the edge portfolio trading fit into? Brad, that would actually be for the most part, that would be in fast trading. The reason that it's in fast trading is because most of us are retail traders. Our order flow is going to, go out in that manner. I'm a Schwab user. So my order flow has been bought out by the fast trading firms. So then it's going to be reflected in that fast trading bucket. Obviously, I'm not a fast trader, but because they've bought out the order flow, that's the way that it's going to be represented. Hopefully that makes sense. I'll continue with the narrative here for a moment. You've heard me the last couple of days talking about the SPY and what's going on there. Actually, before I get there, let me show you what's happening with short volumes across the market. So short volumes have come to basically a standstill right at about 52%. It's been that way for about 5 or 6 days in a row, slightly elevated, and well, moving higher and then slightly at an elevated position. If we move back, I've only really seen this happen one other time during the course of this year, and it was right through here. So we were at elevated short volume levels. This was coming out of the recovery after the April tariff drama, and the market basically flatlined for a period. You can see SPY 596. We fast forward about a week or so, and we were right there at about 596. So we paused for a period of time, and then the market continued to accelerate higher. Do we do something similar right now? I don't know, but that's something to watch. And I'd mentioned in the last couple of market desk notes that, if we do get some short covering, it's a pretty positive environment right now. Sentiment moving higher, so we have good demand in the marketplace. If we get any type of short covering, to me, that would be beneficial, for seeing further gains. So that's the short volume piece. Let's take a look briefly at what's going on with SPY. We don't move above neutral very often for the SPY, and part of the reason for that is it's a blended instrument. So about 70% of the market is some part of large cap blend. In other words, that emphasis both on value and growth characteristics. And that's why the SPY, for the most part, is always stuck at 5. And you can see it here during the course of this last year. You have brief instances where it moves above 5, and then it goes back to 5 again. You can see it's been at neutral really since July going forward, and we're just now making that charge higher. What tends to happen when we do get to 5? Well, we tend to flatten out. If we look back at January trading, you can see that we flattened out for a period of time, and then we moved higher. This was an exception, and we've talked about that, an extreme outlier in the data set. But if we look at this activity, flattened out, and then we proceeded to move higher. Let's back it up to the previous quarter, because we had another instance there. So October through December, and it was actually similar activity. We moved above neutral. You can see the market flattened out for a period of time and then moved higher. Now recognize that with any data here, we're talking about central tendencies, but that tends to be what happens. The market does tend to go higher, but it's not linear when we walk through it. And then once again, why are we talking about this right now? Because we are in the middle of SPY just starting to move higher just the last couple of days. And I think part of the reason for this recent move higher was that push that we saw right through here. That was a huge push there for about a week or so. And I think that has nudged us up above neutral. Let me stop for a second and see if any questions have come in. Have I missed any questions? I think I'm okay right now. Okay. We will continue then. So SPY, I mentioned this morning about divergence in the market. And just as a reminder, most of you are familiar with this, but when we are talking about divergence, and Forrest, go ahead. Do you have a question? Forrest, did you have anything? If not, I'll continue. Okay, thank you. For some reason, the hand was just raised. Thanks for letting me know that. When we talk about divergence in the market, of course, we're talking about rising sentiment and short volume that is moving lower. And I wanted to show you a couple of items where we've had some recent divergence. And it was interesting how that was manifesting. I create different, portfolios. One of them is mid-cap portfolio. And look at this recent divergence, really good demand, short volume really moving lower. It was very evident that mid-cap stocks have had a period of divergence. You look at communication services for the sector as a whole, look at demand rising and short volume really moving lower at the same time. And if we chart that out, and I'll show you what that looks like, let's compare it to just the SPY, and we'll put those two on a chart. So mid-cap ETFs and then communication services. And take that back during the course of the last month. So blue is SPY, and look at that period of outperformance, both for mid-cap stocks and communication services. What was going on in the background? Well, once again, really, really strong divergence. So when you do see those periods of divergence, it is very conducive to appreciation. And I just wanted to, just remind you what was going on there. When we look at the overall market right now, I mentioned that it's a market in need of short covering, and you would say this is a pretty good environment, right? Sentiment moving higher, once again, waiting for that short covering. If we look at what's happening in our daily trading ideas, if you guys track along with us, you've seen days. This is all the names. This is the ones that hit the criteria every day. But for momentum, I believe there was 15 names yesterday. Today there's 6. Low volatility was roughly the same number, but there's been a bit of a battle in the marketplace between momentum and low volatility. Which one is going to win? And if we look in the background for our model portfolios as an example, this is our momentum model portfolio. So our edge focus momentum portfolio. Year to date, it's done fantastic. It's up 38% versus about 17% for the S&P 500. But ever since the end of September, beginning of October, it's run into some issues. We were up nearly 50% for a period of time, and it's struggled since then. There's no other way to put it. It's still up sizably versus the broad market, but certainly not the same type of performance, that we had there for a period of time. What's happening to the momentum portfolio? There might be other factors at work, but look at what's happening from a demand perspective. So if we look at demand cycles, and let me back this up to give you a better idea of this. We'll back it up 3 years. And once again, the green is market structure sentiment, our algorithm for demand, normal rhythm of the market. Demand will wax and wane in the market. It's just the way that the market works. And you look at the bull market, both in 23 and 24, it had very, similar tendencies. And we look at what's happened here recently, especially there in September. Remember, I just showed you September, October really started to tail off. What are we noticing for those demand cycles? They're not as strong anymore. There's been a shift there. We're not getting the same type of momentum in the market. We'll circle back to this look here in just a moment, but I think that's part of the reason why the momentum portfolio has been a little challenged. It's because we're not having those same demand cycles in the market. If we look at the low volatility portfolio, it's done much better year to date. It's up almost 67%, once again, versus 17% for the broad market. A little bit of a hiccup here the last week or so, really charged higher there for a period of about a week. I showed you what was happening there. Active and passive investors really charged into the market, and 10% appreciation in a little over a week is crazy, but that was almost all big tech behind that move higher. And I wonder if that's part of the reason that we've had a little bit of a reversal. When you look at the energy that went into that move, and this is once again the SPY, that is a lot of energy translating to that type of appreciation. And I call it too far, too fast. And sometimes when you have a violent move higher, you need to absorb that move for a little while. I think we're in the middle of that. You can see that playing out here during the course of the last few days. Let me circle back here for a second, see if any questions have come in. Okay, looks like we're good there. Fantastic. Just have a couple more topics. Let's see. Brad, I'm not sure. Brad's asking, lately the RUT has been lagging SPY and Qs, but today all of a sudden the roles have flipped. That might, one thought there, Brad, it might have to do a little bit with the potential rate cut next week. So that might be playing into it a little bit. That's just one thought off the top of my head. But there might be other factors there that I'm missing. Let me show you something that Tim has been doing a little bit of work with. Tim does a great job with working with our model portfolios. He does a great job with everything, but working with model portfolios, going through some of those things. He's been doing a little bit of analysis in Grok as well. So this was some info through yesterday, or as of December 3rd. So looking at the metrics right now, and once again, this is Grok doing the analysis. Expected 5-day move about 2%, expected 20-day move about 6 to 6.5%, probability of positive 20 days, 80 to 82%. Not a really high percentage of being up by 10% in 50 days. But you can see some of the things that are going on in the background right now based off the current market info. One other thing to plug in there, though, and that's the fact that, what is the potential downside risk right now? And there's not a lot of downside risk, but there have been a couple of instances. About 5% of the time with this present setup, we saw the market drop 10% or more within the next 50 trading days. The worst outcome was down about 14% over 50 days. That was in the latter part of 2021. And I've mentioned this, I believe, in the last couple of times that we've done these meetings. I'll mention it again. with today's meeting. I don't know if this has validity or not, but it goes back to the demand cycles that we're tracking in the market. And let's go back to that 2021 time period to show you what was happening there. So 2021, we were charging higher. We had those normal demand cycles in the market. And then third quarter, those demand cycles really tailed off. Now, recognize when we're talking about that type of activity, it has a little bit of a lag often before it starts affecting the market. When did we start to see some downside in the market? Right when we got to the new year. And then that, circled into a bear market then for 2022 trading. Once again, look at the similarities here with a weakening of demand cycles. And you don't see anything like that really in the data, maybe just a little bit through here. What did that produce? Downside in the market. But I circle back to 2021 for the closest comparable to what we're seeing over the course of the last few months. Now, does that mean that it's going to manifest that way? I don't know. Demand could heat up again in December and we might be just fine. But that is something that we're watching. And as you saw just in that Grok analysis that Tim had, that was a potential risk that Grok threw out there as well. I'll stop sharing for a second. Candace, thoughts on how the AI bubble concerns are playing out. Your current AI portfolio is 2.6 to, so that's a variance right now, Candace. Like lowest players 2.6, highest 9. Is that what you mean by that? Okay. You see different things in the media in regards to the AI bubble itself. A couple of big players recently said, no, it's not going to happen. Take that at face value, right? Sometimes some of those market players are playing their book. If they have AI positions, then they're going to talk them up, of course. I'm not too concerned right now about an AI bubble. I could be wrong about that. I think we still have some room to run, but that's just my opinion. In terms of big tech itself, let's circle back to that for a second and show you what's happening. And as you know, big tech comprises 36 to 37% of the S&P 500. So as a general rule, as big tech goes, so goes the broad market. What is big tech doing right now? Well, it's been in rally mode. And part of that is this appreciation that we've seen, across the market. The market as a general rule doesn't tend to collapse when big tech sentiment is above 5. It's just difficult for it to do so. We mentioned earlier that there has been this component, I think, of too far, too fast. And I think we're going through a little bit of a consolidation. But when we think about some of the previous things that we've talked about, short volume stuck at high levels, what tends to happen, you tend to pause and move higher. What tends to happen with SPY above 5, well, you tend to pause and move higher. So I think we're probably in this pause period at this particular time. With that in mind, let's talk about our path forward. We've already hinted at this. I think we need some short covering. If the rally is going to continue to move higher, we're stuck here at a fairly high level. We're at 52%. If we look at the norms for the S&P 500, and right now I'm showing you our S&P 500 report. The norms on a 200-day basis, that's 52%. The last 50 days, it's been at about 51%. So we're tracking a little above norm at this particular time. That's why I think we need a little bit of short covering. Let me see if I can read my own writing. Next week, of course, next Wednesday, we have the Fed. Do we get any surprises with the Fed announcement? Everyone is kind of expecting a rate cut right now. If we got more of a cut than expected, maybe that might juice the rally. And of course, the discussion afterwards always tends to move the market as well. When I consider where we're at right now in this cycle, and let's move this back to a 1 year look. When I'm thinking about the path ahead right now, I'm looking at sentiment, I'm looking at short volume. I'm also considering context. Obviously, context incorporates things like options expirations and the Fed decision and that type of activity. To me, it also incorporates where we have been so far this year. The market has been in rally mode ever since April. And as a general rule, a body in motion tends to stay in motion. It's just the way that things work out. Now, could that not work because of this weakening demand cycles? Sure, absolutely. I I personally think we pause and then continue to move higher because I think that's how market participants are positioned here at year end. Perhaps it plays out differently, but that's part of what I'm looking at. I think that's most of what I wanted to cover with the path ahead. The consideration of short covering, that consideration of the Fed next week, and then how do market participants want to position themselves as we get closer to that year-end time frame. I think that's everything that I wanted to cover. Let's see if there's any other questions here that I missed. Looks like a couple of items came in. Mr. Garcia, would you have anything to discuss with us? Feel free to just take your mic off or unmute yourself if you'd like to. While we wait to see if you have anything, we'll check on a couple of the questions. Anesh, you asked about a portfolio for mid cap. Let me see if I missed any other ones. Let me show you how you can do those portfolios, and you can do them for anything that you would like there. Pretty easy to create those. Let me get to my portfolio page. So it's quite simply market cap equals mid cap. So you can do that for any of those portfolios. You could do it for mega cap, for large cap, small cap, and anything that you want. So I have all of those portfolios. I find them helpful. You've heard Tim talk about the mega cap portfolio, often. That is one that I would include. And once again, that's the same criteria that we just discussed. Market cap equals mega cap. So that's how you create those. Let's go back to the questions for a moment. Question regarding Netflix is very low supply like Netflix an opportunity? And let's go and take a look at that one. So pull up Netflix. Okay, and you can see the very low short volume that was referenced. In general terms, yes, it is an opportunity. Here's what I would be careful with Netflix itself. It's just coming off a demand low at 1 out of 10. What that generally means is that that share price has been washed out. And you can see that Netflix has had issues here over the course of the last month or so. Let's take that back a little further. You can see how that plays out. It's not been up to a sentiment 10 for the last 3 months. It barely got up to 6 or 7 last time. It's currently at 2.6. So supply is terrific. Demand is weak. So this would be more, in my estimation, would be more of a value play. if you wanted to do something like that. It's a safer play when sentiment does get above 5, though, just for what it's worth. So what that means when supply gets washed out or when it's really low, though, there's less supply out there, and when demand does heat up, um, it's easier for share price to move higher because there's less supply to move through. So that's the way that you can think about that. But it's lacking the demand element at this particular time. Brad's asking a question. What time of day is best to enter the edge focus trades? He's in the Pacific time zone, and trading at the open is a bit challenging. Brad, I tend to trade the last 10 to 15 minutes of the day as a general rule. I don't have time to watch things during other times of the day. Let's say, for an example, that we were in a real momentum market. Our daily momentum names were up to 40 or whatever. You could take things kind of at the open if they were within the range. There's probably a pretty good opportunity or pretty good chance that they would rally by the end of the day. We're not in that type of market right now. So just as a general rule, both Tim and I tend to leave our daily trades to the end of the day and then trying to make money on those during the next couple of days. Question about Michael Burry, Bruce. A question from Bruce. Michael Burry keeps talking about a huge pullback in the near future. Can Edge foresee this happening? Bruce, to a certain extent, I think I talked about that already with the demand cycles. We are seeing a weakening in the demand cycles. Does that play out perhaps in the early part of January as weakness in the market? I think there's a decent chance that it does right now. It's something that I'm keeping in the back of my head. I normally put more, this is me personally, I normally put capital to work at the beginning of each month with that thought in the back of my head. I didn't do it here in the early part of December. I could be wrong. We could continue to charge higher, but those demand cycles right now are not great. Brad had a good point of Brad was responding to Bruce, that Michael Burry has a huge short position on Nvidia, so he's playing his book, and yes, that can happen at times. But once again, I am watching those demand cycles in the marketplace. Question regarding Lilly. Can we please review that? It's a little bit confusing. Absolutely. Let's go ahead and take a look at that one. And thank you for the questions. These are terrific. Once my mouse allows me to get up there. All right. So with Lilly, we'll see this sometimes with really strong stocks. And what am I referencing? Look at when it went to 10 out of 10, which was the early part of November, and it stayed at 10 out of 10 for almost a full month, and it just dropped down to 9 out of 10 as of yesterday. What's going on with the reversal? Well, it was plugged at 10 out of 10 for the longest time. That's going to play into it at some point. When did the reversal start? It started right before month end. Recognize what's happening at month end. We have month end index options, and that's going to be something that that's going to affect passive investors. What was likely happening to Lilly? Probably overweight. Look at the appreciation here. We'll just start when it went 10 out of 10. 924 all the way to its highs at 1109. Tremendous appreciation. What that's going to do in some passive investment portfolios, it's going to put Lilly in an overweight status. What's going to need to happen at month end is going to be a need for a little bit of selling activity. So that's part of what I think is going on there. just 10 out of 10 for the longest time. And I think it went into an overweight status in some passive investment models. Question from Barry. I noticed that there's a download data link when you show SPY. Can you do this on individual stocks? Not right now. Hopefully, in the future, Tim does a great job with our engineers, kind of taking your suggestions and adding to them as the engineers have time and as we have the resources. But please keep the ideas coming. And we'll try to incorporate them over time. But great questions. Can I cover anything else for you guys? We're kind of coming up at the end of our time here. If not, thank you very much for all the questions today. I really appreciate it. I'll go ahead and stop the recording. And just want to wish you guys